Hello and welcome to Socioquatic, a one-stop destination for SSLC Social Science. Do you wish to score well in exams? Then you are at the right place. So without any delay, let's get started.
Hi friends, I am Prashanth Kumar. Welcome to my YouTube channel Sociocritic. We are discussing about the public finance and budget. Already one video we completed, and in that we discussed about the public finance meaning, budget and public expenditure. This much we discussed already. In this video, let's discuss about the public revenue. And also here in the revenue, tax revenue, non-tax revenue, and also capital revenue. About that we have to discuss, and then afterwards public debt and deficit financing. This much we have to discuss in this video. So friends, let us start with public revenue. Yes, yeah. What is public revenue? The income mobilized by the government for the purpose of financing the government's activities. Yeah, so government is doing many activities. To do these activities, government should mobilize some finance or income. It has to raise income. So this raising income is called as public revenue, income of the government. Okay, yeah. And here revenue receipts means what? Revenue receipts. The revenue generated by the government through tax and non-tax sources. Yeah, tax and non-tax sources is called as revenue receipts. And here revenue receipts are of two types. And commonly here what happens, revenue income, central government separate and state government separate, their income they will calculate. Yeah. And here the tax revenue and non-tax revenue are the two types of revenue receipts. And what is this? The revenue generated by the government through this tax revenue and non-tax revenue. There is a revenue. So let us discuss about each tax revenue and non-tax revenue. Yeah. And what is tax revenue? Tax revenue is the tax. What is the tax? Tax is a compulsory payment. It is made by the citizens to the government without expecting any direct benefit in return. So whatever the citizen they pay to the government, that is the tax, but they can't expect directly. If we purchase something in the shop, by giving money we'll get some goods. So here whatever we pay to the government, directly we will not get anything. So indirectly we'll get all the facilities. By using these taxes, government will provide all the facilities to the people. That is the duty of the government. So the tax is a compulsory payment. Everyone should pay. It is not option. Compulsory payment by the citizen to the government without expecting any direct benefit. Yeah. And here, while levying tax also compulsory, okay, but everyone should pay equally. No. Government imposes higher tax on high income group or luxury goods. So vehicles, luxury cars, high tax, or luxury goods, whatever you use, so on that more tax. Essential goods, tax very less. So government imposes higher tax on high income group or luxury goods and services, and lower tax on low income group and goods and services which are having necessary or essential goods. Yeah, so goods and services used by the common people on that low tax. So this type of taxation is called as progressive taxation. Yeah, what is progressive taxation? Government imposes higher tax on higher income group and luxury goods and services, and lower tax on low income group and goods and services used by the common people. This is progressive taxation. There some justice will be there. Okay, rich people they have to pay more, poor people they have to pay less. So equal distribution possible here. Okay, yeah. Next, direct tax. Here, tax revenue in the direct and indirect tax I already told. What is direct tax? The tax is paid by an individual on whom it is levied. Government levy tax on a person, he has to pay the tax. Yeah, the tax is paid by an individual on whom it is levied. That is a direct tax. Directly they have to pay. Example, personal income tax. If your income is more, you have to pay the tax. Corporate tax, companies etc. they have to pay. Wealth tax, on your wealth you have to pay. Stamp duty. So these are all the direct taxes. Those who use that, those who have that, they have to pay. Indirect tax not like that. Yeah, indirect tax how? The burden of tax imposed by the government is transferable to others. If the government imposes tax on the company, on a person, he can transfer that one to another. She can shift that one to other. Example, let us see, you can understand easily. Tax on the manufacturer. If a manufacturer, one good manufacturer, he will produce a good, he will manufacture a good or services. So for example, one soap company. So this solid soap, bath soap, to prepare that, if they on the sale, the company owner he has to pay the tax, but he will not pay directly. What will he do? He will shift that burden to the customers, consumers. There you can see MRP, maximum retail price. That is written, for example, 35 rupees. For one soap, 35 rupees. In the bracket written inclusive of all taxes. The tax imposed on the manufacturer is shifted to us. We have to pay the tax. That is indirect tax. Indirectly, we are paying the tax. While purchasing the goods, while purchasing soap or anything, we pay the tax in that one. That price, whatever we pay, that included all the taxes. Actually, the tax imposed on the manufacturer and the company, they shifted that one to us. So that is indirect tax. Central excise duty, VAT, value added tax, import export tax, service tax, goods and services tax, GST. Yeah. So actually, that GST came into effect from 1st July 2017, a single goods and services tax. GST, goods and services tax. And here, before that, what happens? Everywhere we have to import, we have to give the tax. From Karnataka to Tamil Nadu, if the good goes, Tamil Nadu government will levy the tax. From there, the another state, they have to levy the tax. Now, not like that. In the GST, 9% central tax, 9% state tax. Once, one time payment it is. Once if you pay again and again, you don't have to pay. Yeah, up to 28% it will be, 18% common, 28% it will be. And here, once if you pay the tax, again and again, don't have to pay. And central government also get the benefit, state government also get the benefit. Equally divided that one. So that is GST. Yeah. And next we have to move to non-tax revenue. Very important, students. See here, these listed, whatever we listed, the non-tax revenue, apart from taxes, whatever the government collect the taxes, other than that, government gets income, government gets in revenue from other sources. Which are the other sources? So actually, what is non-tax revenue? If they ask about what is non-tax revenue, apart from taxes, the government gets revenue from other sources. They are called as non-tax revenue. Which are the types? So first one, uh, profit earned by the RBI. Reserve Bank of India gets some profit while printing notes, etc. They will get profit actually. That profit goes to the government. That's not through tax. And profit generated by Indian Railway. Yes, Indian Railway is profitable one. And that one goes to the government. It's a public, no? So, and revenue generated by the departments of post and telecommunication. So that one also goes to the government. And revenue generated by the public sector industries. Many government industries are there. So they earn profit. So that goes to the government. Revenue generated by the coins and mints, there also. So this goes to the government. And various types of fees and penalties. The fees collected by and penalties. For example, you are not wearing helmet, you are not wearing mask. It's penalties. It will go to the government. Yeah, so that fees and penalties goes to the government. There is a non-tax revenue. So these are the non-tax revenue, very important one. Next, capital revenue. So here capital means huge amount. And what is capital revenue? Capital revenue refers to those receipts which either create a liability or cause a reduction in the assets of the government. Yeah. Example, borrowing lead to an increase in the liability. Borrowing, purchasing. If government purchase something, it increases the liability. Government has to give something, no? When they purchase, they have to give amount, give the price for that. This is a liability of for the government. And receipts from sale of shares and public enterprises. See here, the share of the public, the government enterprises, government companies, etc. It will sell. By that, it will get money, but its assets will be reduced. Assets will be reduced. So they are called as capital receipts. Okay, yeah. And actually, if they purchase anything, they have to give, there's a liability. And if they sell the shares, etc., their assets will be reduced. They will get money, huge amount they will get. So it is a capital receipts. Yeah. And in the capital revenue, other sources of capital revenue. Many times what happens, government withdraw its investment from its own industry. Government industries are there, its share will be there, and its investment on the public industries will be withdrawn. There is a disinvestment. By that they will get money, they can use that money. There is another source of income we are discussing here. And repayment of loans from the state government. Central government will give loans to the state governments, and time to time they will repay that. When they repay, it will be the income for them. Yeah. So loan for that interest will be there. So like this, so other sources of capital revenue for the government. Okay. Now expenditure we saw, revenue we saw. But commonly we already discussed about that deficit budget is very helpful for the developing countries. So here what happens, when the revenue of the government is less than the expenditure, then we have to balance that, we have to fill the gap. To fill the gap between that, we have to take the loan, that is a public debt. So what is public debt? Public debt is the government borrowing money from the internal and external sources. That is called as public debt, public loan, government loans. So internal debt and external debt are the two types. Yeah, what is internal debt? Loan obtained from citizens, banks, financial institutions and industries are called as internal debt within the country. External debt, the name itself says that the loan obtained from foreign goods, foreign governments, sorry, loan obtained from foreign government, foreign financial institutions and international financial institutions. They are external debt. Yes. So these are the income or the money the government gets to fill the gap between income and expenditure, to fill the deficit budget. Okay. So next we have discussed about deficit financing. What is deficit financing? And we studied earlier, the government first estimates its expenditure. Then, according to the expenditure, it raises its income. Income will be mobilized or revenue will be mobilized. And while doing so, usually more expenditure than the revenue, it is common. In the deficit financing, it is common. And in the developing countries, public expenditure is usually higher than the public revenue. So in order to fill the gap between this income and expenditure, the government raises loans. So that one I already told, internal and external sources. And see, the government make many measures to cover up the deficit expenditure. Yeah. Or whatever the income, whatever they have, is not enough to fill that, to cover that, they will make it. Yeah. And from RBI they will take. Yes, central bank. they will take the loan, and or printing additional currency possible. Yeah, so these are the things. And mainly we have four concepts of deficit are used and are calculated as calculated. Four concepts are there. They are fiscal deficit, revenue deficit, primary deficit, and budget deficit. In the deficit financing, this much four concepts are there. So it is used to calculate that. Let us see first one, fiscal deficit. What is fiscal deficit? The excess of expenditure what the government is having over its revenue receipts and non-debt capital receipts is fiscal deficit. For that, formula is there. So that is formula is like this: the fiscal deficit is equal to revenue receipts plus non-debt capital receipts. Revenue, what is revenue receipts? Already discussed. Revenue receipts plus non-debt capital receipts. So capital receipts, it is non-debt, not through the loan. Total of that minus total expenditure. That is the fiscal deficit. And revenue deficit, it is the excess of total revenue expenditure of the government over the total revenue receipts. So revenue deficit is equal to revenue receipts minus revenue expenditure. Directly, revenue receipts, revenue expenditure. Primary deficit is fiscal deficit. So whatever fiscal deficit we calculate here, fiscal deficit minus interest payment. Whatever the loan we take, so on that interest will be the interest payment we have to reduce. And budget deficit is total revenue, whatever we have total revenue minus total expenditure is a budget deficit. Okay, yeah. So the Fiscal Responsibility and Budget Management Act FRBMA was passed in 2003 to check uncontrolled deficit of the government. So it should be some limit for the deficit financing. If it crosses the limit, government will collapse, economy will be collapsed. To control, if the deficit financing is more, it leads to inflation. Fluctuation will be there. To stop that, so FRBMA was passed. That is the Fiscal Responsibility and Budget Management Act was passed in 2003 to check the uncontrolled deficit of the government. Yeah. So whatever it may be, we have to think about the welfare of the society. We have to think about the welfare of the people. So that is the main concept. So we have to keep in mind while doing public finance and budget. Government should think about the welfare of the people while preparing the budget. So this is about public finance and budget. Thank you for listening to me. Thank you. Thank you very much.